The beer's on tap. The cold brew's free. There's a neon sign on the wall telling you to do what you love. And a glass conference room full of people who believe it. Now walk past all of that into the back office where a different document is waiting. A lease. 10 years. 15 years. Floor after floor of a tower in Manhattan or London or Shanghai. And at the bottom, a signature line. One stroke of a pen, and the rent is owed whether anyone ever shows up or not. Keep your eye on that pen. It is the entire case. In January 2019, SoftBank's investment valued WeWork at about $47 billion. $47 billion for a company that rented office space. On paper, that made it one of the most valuable startups in the world. The usual explanation for what happened next is personality, Adam Newman, the parties, the private jet, a mission statement about elevating the world's consciousness, an S1 that read like a manifesto, then the pandemic and the fall. That is the story everyone tells. It is not the mechanism, because here's the uncomfortable part. WeWork's product was real. Real desks, real members, real Fortune 500 tenants. The demand was never fake. What was borrowed was the math. WeWork signed obligations like a real estate company and got priced like a software company. It leased long and sold short. And when the story stopped paying for the difference between those two things, the signatures did not disappear. The obligation stayed. That is the autopsy we're doing today. If you are new here, every collapse on this channel gets run through the same four forces. Market, the demand, the customers, the category the company actually lived in, money, how the company was funded, and what that funding demanded in return. Management, the decisions made at the top, and the governance around the moment. The timing and the shocks nobody chose, all four are always present. Only one is decisive. WeWork is a money case. The market was real. Management made everything louder. The moment delivered the audit. But the decisive force was capital, money that funded a lease-heavy real estate business as if it had software economics. Watch what that does. Start with a problem WeWork actually solved, because it did solve one. It is 2014 and you run a 12-person startup in New York. You need an office. The traditional route, hire a broker, 2 or half-empty floors, negotiate a 5-year lease, post a deposit, then spend months and hundreds of thousands of dollars on build-out. Walls, wiring, furniture, a kitchen. By the time you move in, you might be a 30-person company, and the space is already wrong. WeWork's pitch, skip all of it. Tour on Monday, badge in on Tuesday. Desks, Wi-Fi, conference rooms, coffee. 1 monthly membership. Growing, take more desks. Shrinking, give some back. The rigidity that defines commercial real estate. Gone, for the member anyway. Hold that thought. And the spaces were genuinely good, light, design, common areas that people actually wanted to sit in. Next to the beige cubicle farms most companies inherited, a WeWork floor felt like the future had already arrived. This was not just freelancers on laptops either. Picture a Fortune 500 bank that needs 50 desks in Singapore for an 8-month project. The old answer was a lease, a build-out, and a write-off. The new answer was a membership. By 2019, WeWork's own filings said 40% of its memberships were enterprise customers, and that its member base included 38% of the global Fortune 500. Big companies used it for overflow space, for project teams, for landing in a new city without signing a decade of rent. The same filing counted 527,000 memberships across 528 locations in 111 cities. In 29 countries, 500,000 desks sold 1 month at a time. So let us be precise about what this case is not. It is not a fraud without demand story. The product worked, the customers were real, but the market had hard limits and they never moved. Office demand is local. A desk in Austin cannot serve a member in Berlin. Occupancy decides everything. A floor that's 90% full and a floor that's 60% full are two different businesses paying the same rent. Buildings age. Build-outs cost real money, floor after floor, city after city. Competitors can copy a beautiful floor plan. There is no network effect that stops them. And above it all sits the landlord, who gets paid either way. Here's the most important limit of all. The flexibility members' love did not vanish from the system. It moved. Somebody still had to hold the long commitment, and that somebody was WeWork. Every month-to-month membership upstairs was balanced by a decade of obligation downstairs. WeWork sold flexibility by absorbing rigidity onto its own balance sheet. A market can be real and still refuse to behave like software. Software serves its 10 millionth customer at almost zero marginal cost. An office company's 10 millionth customer needs a desk, a chair, and a floor in the right city. Every one of them bought at full price. The market did not fail WeWork. The market just never stopped being real estate. Now the decisive force. Follow the money carefully because the mechanism here is clean and it is brutal. Start with the basic trade. WeWork signed leases running 10, 15 years. It poured capital into building those floors out. Demolition, glass, furniture, those beer taps, all paid up front before the first member ever badged in. Then it sold access by the month, long on one side, short on the other. Finance has a name for that shape, a duration mismatch. It is the same structure that sits underneath bank runs. Banks borrow short and lend long. WeWork rented long and sold short. Can that work? Yes, in careful doses. Keep occupancy high. Keep build-out costs tight. Expand slowly enough that each mature location proves it actually earns its cost of capital, that before you clone it 100 times. That discipline is exactly what abundant capital removed. Because WeWork was not funded like a real estate company. It was funded like a rocket. SoftBank's Vision Fund, a vehicle of roughly $100 billion, the largest fund of its kind ever raised, kept writing checks. Picture that term sheet for a second. January 2019, a private funding round that valued the company at about $47 billion, larger than many of the publicly traded landlords who actually owned the buildings WeWork was renting. At that altitude, the meaning of every number inverts. Losses read as momentum, lease obligations read as market capture. Look how much territory we've locked up. Cash burn reads as proof of ambition. Every warning light gets reinterpreted as a speedometer. The company even built its own instrument panel. In a 2018 bond offering, WeWork introduced a metric it called community-adjusted EBITDA. Earnings before, among other things, marketing and administrative costs. Profit before most of the expenses. Investors and journalists mocked it. But notice what it reveals, a real estate business reaching for accounting language that could tell a software story. And valuation was not a scoreboard here, it was fuel. A higher valuation unlocked more capital funded more leases. More leases made the growth story bigger. A bigger story justified a higher valuation. A flywheel, with no break anywhere on it as long as belief kept flowing. Then in August 2019, the company had to file the document, the S-1, public, audited, no adjustments, 2 numbers. Run rate revenue as of June 30th, 2019, $3.3 billion. Sounds enormous. Future undiscounted fixed minimum lease payment obligations on leases signed as of that same day, $47.2 billion. And around that stack, the filing described the supporting hardware of a property business. Guarantees, letters of credit, commitments. A landlord demands when a tenant promises 15 years of rent. Say those together slowly. $3.3 billion coming in. On flexible commitments members could walk away from. $47.2 billion promised out. On commitments WeWork could not walk away from. And notice the eerie symmetry. Private investors said the equity was worth about $47 billion. The lease stack said the company owed about $47 billion. The story and the obligations were the same size, only one of them was legally binding. This is why WeWork revenue and software revenue were never the same substance, and software revenue gets stronger as it scales. Each new customer costs almost nothing to serve. Every new dollar of WeWork revenue arrived, dragging years of fixed obligation behind it. Scaling the company meant scaling the exposure. Growth was not the escape from the problem. Growth was the problem, compounding, which surfaces the question nobody had to answer while the checks kept coming. Did a mature WeWork location, 5 years in, fully rented, actually earn back its cost of capital? In a disciplined funding environment, that question gets answered before the 100th location. In this one, growth made the question unnecessary, and money made growth unlimited. Capital did not merely accelerate WeWork, it subsidized a model before that model had earned the right to scale. And it silenced every signal that would have said so. That is not a side effect. That is the cause of death. Now the amplifier. And let us be precise about what management actually got wrong, because the founder was weird is not a diagnosis. The core failure was translation. Management asked investors to see a technology platform, a global network, a movement, in the S1's own words, a mission to elevate the world's consciousness. The filing read less like a prospectus and more like a manifesto. By press counts, the word community appeared well over 100 times. Picture the analysts who opened that document expecting a tech prospectus. Page 1, a dedication to the energy of we, deeper in the machine, leases, tenant improvements, guarantees, deep widening losses, a cost base that resembled property operations, not software infrastructure. The gap between the story on page 1 and the numbers in the back, management had built that gap deliberately, year after year, because the story was what the funding was priced on. The pitch decks got to define the company for as long as the company stayed private. The S1 was the first document management did not get to fully control. Then came the governance, and it turned a credibility gap into a credibility collapse. Neumann held super voting shares that gave him control of the company regardless of his economic stake. The filing disclosed related party transactions, including leases with landlord entities in which Neumann had had a significant ownership interest. Read that again. The chief executive stood in effect on both sides of some of the company's own rent. Reporting around the IPO described the company paying its founder millions of dollars for the trademark to the word we. A payment returned after the backlash, and while the company burned cash, it operated a private jet reported to have cost more than $60 million. Any one of those items on its own, a company can survive, all of them in one document. At the exact moment, WeWork was asking public markets for the largest act of trust in its history. That raised the price of belief, just as belief was the only thing holding the valuation up. But here's the discipline of this framework, and it is what separates diagnosis from gossip. None of that created the duration mismatch, run the counterfactual. Give WeWork a humble, boring chief executive with 1 vote per share and no side dealings. The model is still long leases funded by monthly memberships. The obligations are still $47 billion. The valuation logic is still borrowed from software. Governance did not build the bomb. It shortened the fuse and made sure everyone could see the wiring, and the day-to-day operating posture matched the story, not the balance sheet. The expansion ran at maximum speed into new cities and new buildings because in the narrative, territory was the prize and discipline was hesitation. A management team judging itself against a growth myth will keep signing. A management team judging itself against unit economics would have slowed down years earlier. That is what an amplifier does. Management widened the gap between what the business was and what the story needed it to be. And when the re-rating finally came, that gap is exactly where the company's credibility fell into. Loud, expensive, real, and still not the root cause. The moment arrived in 3 acts, and every act was an audit. Act 1, the IPO. August 2019, the S1 goes public. For years, private investors had funded a story. Now public investors read a document. Within weeks, the valuations being discussed reportedly fell from $47 billion toward the low tens of billions and kept falling. By the end of September, the IPO was withdrawn entirely. Neumann stepped down as chief executive. SoftBank stepped in with rescue financing that, by wide reporting, valued the company at a fraction of its January peak. And Neumann's own exit terms, reported at the time to be worth as much as $1 billion or more, were later contested and renegotiated. Roughly 9 months from $47 billion to rescue. Nothing about the buildings changed, only the audience did. Act 2, the pandemic. A company carrying enormous fixed office obligations walked into the one scenario worse than expensive offices. Empty ones. Whole cities sent their workers home. Office behavior became unpredictable. Demand became impossible to forecast. And the asymmetry at the heart of the model turned vicious. Flexibility mattered most to members at precisely the moment rigidity hurt the operator most. Members could cancel with an email. WeWork could not. The rent on hundreds of locations came due every month, whether the neon signs were lit or not. Act 3, the capital reset. In a zero-rate world, investors can talk themselves into duration. Category creation, eventual operating leverage, profits that live years away. When rates rose, the same story got translated back into present-tense cash obligations. On November 6, 2023, WeWork filed for Chapter 11 in the United States, saying it needed to rationalize its lease portfolio and restructure parts of its debt. Read that rationale again, the lease portfolio. 4 years after the failed IPO, 3 years after the pandemic. The thing being restructured was still the same stack of signatures on June 11, 2024. The company announced it had emerged from Chapter 11, its restructuring complete. A smaller WeWork survived, but it survived by doing in bankruptcy court what capital had never forced it to do in growth. Walking away from leases the model should never have signed. Moment mattered, but the moment was an auditor, not an assassin. It examined a weakness that had been sitting on the balance sheet for years. So, what killed the old WeWork? Market? Real, but physical. The demand existed, the memberships, the enterprise customers, the Fortune 500 logos. None of it was imaginary, but that demand lived inside buildings, occupancy rates, and local rents, and no story could relocate it. Real but physical, not decisive. Money? Decisive. Cheap, abundant, story-hungry capital funded a long lease, heavy build-out real estate model as if it were a software platform. It let obligations compound faster than durable economics. It turned valuation into fuel, and it suppressed every discipline signal that would have forced the model to prove itself before scaling. Decisive management, the amplifier, super voting control, related party dealings, a manifesto where a prospectus should have been. All of it widened the gap between the business and the story and made the re-rating merciless when it came. Loud, costly, and still not the root cause. Moment, the audit. The IPO process read the document. The pandemic emptied the offices. Higher rates repriced the promises. 3 examiners, 1 verdict. On a test the company had already failed in private. Now come back to that pen from the cold open. Every neon sign, every beer tap, every beautiful common area sat on top of signatures. 15-year signatures collected at software speed, funded by investors, pricing them like code. The members' commitments were monthly. The companies were decadal. And when belief stopped paying the difference, the story evaporated. $47 billion of it. But the $47.2 billion of ink was still legally binding. The simple version says WeWork was overhyped. The precise version says WeWork was mispriced. A real product got wrapped in the wrong valuation framework. And once that happened, growth became easier to finance than to understand. That is the transferable lesson, and it goes far beyond co-working. Ask it about any company you are building, funding, or studying. Is the money testing this model or protecting it from the test? Capital can help a company discover its true scale. It can also anesthetize a company against the pain signals that would have said, this model at this speed is scaling the wrong thing. WeWork did not run out of demand. It ran out of belief. With the obligation still on the table, the product was real, the math was borrowed, the signatures were permanent. That is the WeWork file, a money case closed. Next case, Xerox, the company that invented the office of the future inside its own lab, and then handed it away. A management story for the ages. If you want the next case before it goes public, join the free corporate anatomy briefing. The link is in the description.